All right. Today is Monday, December 5th, and this is a Charts to Watch update. These are charts that we covered in the past few weeks or so. And the way we're going to do this is I'm going to go back and play what I said when I covered these charts initially, and then come back and give you an update and see what's going on. Sounds like a plan? All right, let's do it. We start with the ticker AMC. Take a look. And here's another chart we haven't talked about in a long time. Any apes still alive? Raise your hand. And if you're still alive, I got some good news for you in the daily chart for AMC. It looks like we have a bull flag consolidation pattern. It's supposed to play out. And if it does play out, take your profits and run away. Take your profits and run away indeed, because look at this. Since then, AMC popped significantly higher by about 22%. Now you get this kind of gain in this kind of market, and you know what the strategy is. Always be closing, because if you don't, check out what happened today. AMC, from that point on, down about 19%. All of these gains, poof. Gone. So the lesson of the day is, once you make significant profits in a short amount of time, specifically buying call options, you close the trade, you take your profit, and you thank the Lord, and you move on. Next, what about the ticker AMZN? Amazon. Let's go back and hear what I said, and then we'll come back and check how the chart developed. Because sometimes, not all the time, but sometimes, in Thanksgiving week, the market reacts by pumping these retailers. Be it Amazon, be it Target, be it Walmart. So let's look at some of those, and we start with the ticker AMZN, Amazon. We got a massive rebound in the aftermath of the CPI, which got us all the way to the Fibonacci resistance, and now the chart formed a double top formation. This is what the bears are looking at. The bulls will counter and say, wait a minute here, this could be an ABC pattern, which will take us all the way to closing the gap at 111. Now, even if that happens, we'll look at the weekly chart. Who's in charge here? You look at the RSI, it is in negative divergence. You look at the MACD, also in negative divergence. And again, in all likelihood, we're going to go down in a retest of the 2020 bottom. Unbelievable. We talked about Disney going down to the 2020 bottom. Now we're talking about Amazon going back to the 2020 bottom. If that is the case, will the NASDAQ also go down all the way in a retest of the 2020 bottom? Well, that's not going to happen without Apple, Microsoft, Google, and Tesla participating in the downside. In the case of Amazon, if there is a downside all the way to the 2020 bottom, that would be a downside from this point on for around 14%. And here it is. Since then, Amazon is down about 3.5%, and it looks that it is on the trajectory to go down all the way and retest the bottom from 2020. Not a chart I want to be in here. Maybe after it goes down and forms the double bottom, maybe I'll go back and take a look at it. But for now, stay away. This is probably going to go down all the way to the 2020 bottom. Next, what about the ticker BUD, Anheuser-Busch? Take a look. We have a descending, sloping line of resistance. But the chart here in the weekly chart moving its way higher, making a higher low, and it's about to challenge the sloping line of resistance once again. And here's the update. This is a monthly chart, by the way. And since then, the chart is up about 11.5%. It is now battling the resistance of the sloping line. Is it going to make it? We have indicators that it will. Now, what it might do first is go down a little bit, gather some energy, find some support, and then move higher again. And look, these beer, alcohol stocks, these are the kind of stocks you want to be in if the economy and the market is heading into a recession. There is no mania here. There's no overvaluation. This stock has been beaten, bruised, and it never recovered since the 2020 crash. Perhaps now is the time for these kind of stocks to shine. Next, what about the ticker CAG Conegra? Take a look. Another name, in this case, Conegra, the ticker CAG, and this is a monthly chart. Again, this is a giant bull flag, which looks like it's going to play out, and it appears that this name will tend to outperform in a recession. It's a name that I'm certainly keeping on my list here because these kind of frozen food companies, they tend to outperform under a recession. And again, this is a monthly chart for the name, and since then, it is up by about 5%. And I do like this formation a lot better than the bull flag. You can look at it either way, but this is a formation of lower highs and higher lows, and we have a breakout in this consolidation. Now, this is a monthly chart for the name. It's going to take time for it to develop, but again, it is the kind of name you want to be in if a recession is about to hit the economy and the stock market is going to shift into the recession theme. And I did put my money where my mouth is, and I added the name to my long portfolio, and it is a large position. I'm readying my portfolio for the recession theme. And this is a name you got to take a look at and consider at least. Next, we have the ticker FCX Freeport McMoran. Let's take a look and then come back. About a weekly chart for the ticker FCX Freeport McMoran. This tracks copper. Now, copper was down today. We're talking about futures. But again, If the dollar continues to go down, this chart is going higher. We're not saying it's going to make a new all-time highs. We're saying how about a retracement all the way to close the gap at around 40.21. But the condition here is the dollar has to continue to go down. Otherwise, this is not going to happen. You see this pattern across the market, the double bottom, even in some of the indices. So we are now at a critical level. Either these double bottoms are going to play out, or we see a fourth quarter rally, a Santa rally if you may, at least in certain names, or it's going to fail. It's going to fail miserably. And it's going to produce the biggest leg in this crash yet. How do we know which one is going to happen? The CPI will be a leading indicator, but most importantly, the reaction of the US dollar by the end of the week. And here's the update. This is a weekly chart for FCX. On target, it closed the gap at 40.21, and now it appears it is curling its way down. So we're done with the trade here, and by the way, this could be a leading indicator that the dollar is bottoming. FCX goes down, the dollar finds a bottom. If that is the case, it's not going to be good for the equities market. We'll talk about this a little more when we do the regular show this evening. But before we do that, let's check out the chart of Google and then come back. Now, a better looking chart in the big caps. Forget about Amazon. How about Google? You look at the weekly chart here, it's way above the 2020 bottom. We see the MACD curling its way higher. Perhaps it's going to cross at any point now. We have a bump in the RSI. It doesn't mean that this is the bottom for Google, but it means it's a much better looking chart than Amazon. If you must play the big caps one way or the other, how about you play Google instead of Amazon? And here's the update again. In the battle between Google and Amazon, if you want to catch a big tech rally, Google performed a lot better than Amazon. Amazon down about 3.5%, Google up about 5.5%. But what now? It is looking a lot better still versus Apple versus Amazon, maybe not as good as Microsoft. But folks, if the bear market rally is over, and we have a lot of indicators, at least today, that say perhaps it is, then you really think Google is going to go higher from this point on? I don't think so. This is a weekly chart. If you made 5.5% in a couple of weeks or so, maybe you should take your profits and step aside. Next, what about JWN Nordstrom? Let's hear what I said and then come back. Here's another retailer, JWN Nordstrom. We have a sloping descending line of resistance, but the chart is about to cross above it. We see support in the RSI and the MACD. The technicals say JWN will crack above this line in a big way, but mind you, we have earnings this week, and if earnings come out ugly, it's not going to make it. We could see a massive down day. So before you bet on such outcome, maybe you should wait for earnings to come out. And here's the update, the weekly chart for JWN. Since then, the name is down about 10% or so. But mind you, this was a Thanksgiving week, Black Friday kind of trade. So we were not betting that JWN is going to go higher significantly and this should be added to the long portfolio. None of that at all. It was a call options trade, pre-earnings, playing the Thanksgiving week holiday. And guess what? If we zoom in to the daily chart for JWN, before earnings, if you bought the calls, and I announced that I bought the calls before earnings, a day before, the stock shot up higher by about 8% right before earnings. Now, options trading 101. You buy call options, the next day the stock shoots up higher by 8%, and you have earnings coming out later that day, meaning the premiums are elevated for now. You made a significant amount of profits holding these call options. If the stock shot up higher by 8%, your call options appreciated by 300-400%. What do you want more? Once again, you close, take your profits, thank the Lord, move on. Next, we have MCD McDonald's. Let's take a look and come back. Here's another one, McDonald's. A lot of charts looking really ugly. McDonald's is making new highs on the weekly chart. Once again, this is a weekly chart, no update here, it's still consolidating in a bull flag pattern. Now, McDonald's is the kind of stock you want to hold in your portfolio if we're heading into a recession. When the market finally shifts into the recession theme, McDonald's is going to outperform. And by the way, McDonald's has been outperforming for a long time now. But keep in mind, in the initial crash, when it happens, just like we saw back in 08-09, everything goes down. But I remember quite vividly, right around March 2009, around the bottom, the talk was the things that crashed fast, the stocks that are down 70-80% from the top, these are the kind of stocks that move higher first when we get the bear market bottom. Now, this is a falsehood. So what they're saying right now, when the bear market ends, the stocks that you want to buy are the Carvanas, the RKKs of the world. False. Wrong. some of these names will go bankrupt. What you want to buy instead, and this is exactly what I did back in '09, March '09, I bought fast food, I bought tobacco, frozen food, these kind of stocks, including McDonald's. And it outperformed the S&P and the NASDAQ significantly in 2009. So keep this in mind. If we have an initial crash, everything goes down, perhaps McDonald's goes down all the way to 240, even below, something you want to think about in terms of picking this name and adding it to your portfolio. Now, it could continue to go higher from this point on. So if you want to pick it up right now, no problem. But make sure that you're hedged just in case if McDonald's also goes down along with the grand finale of the bear market when we see a big crash in the equities market. Very few names can be spared. But after that happens, McDonald's would be a significant outperformer. Next, what about the ticker PAYC, PAYCOM? Let's go back and hear what I said and then come back for an update. Here's a monthly chart for the ticker PAYC. This is a company called PAYCOM. Now, with the wave of layoffs upon us, this company is going to suffer. It does HR, employee salary management, all that stuff. What we see right now is a head and shoulder formation. If that plays out, the name goes down, we could see a decline all the way to the next Fibonacci support. That would be a downside from this point on for about 25%. And here it is, a monthly chart. It's going to take a long time for development, but since then, the name is up about 5.5%. But look at the RSI, look at the MACD. All of these technical indicators point out that what I'm seeing here will play out. We will see PAYCOM going down significantly. But even when we look from a fundamental perspective, if we do have a massive wave of layoffs coming in 2023, this is exactly the kind of stock you don't want to be in. You might want to short it instead. Next, we have PFE Pfizer. Take a look. We will look at healthcare names, and I'm talking about the big pharma. Forget about the health insurance or the biotech. We're talking about big pharma names, classic names, such as Pfizer, PFE, weekly chart. We have a sloping, descending line of resistance, but the chart is working its way to crack above this line. You look at the MACD indicator, we see positive impressions indicating that the chart is working its way to crack above this line. And here's the update. Since then, Pfizer is up about 6.5%, and it did break above the sloping, descending line of resistance. Notice that the SPY didn't make it above the sloping line, at least from today's action alone. It appears that we have a reversal. The NASDAQ didn't even make it in a retest to the sloping line of resistance, at least not yet. But Pfizer is already ahead. PFE already succeeded this test of a sloping line of resistance. So do I want to be in the SPY or the Qs and take a gamble, or do I want to be with the chart that already made it? And in this case, it's Pfizer. It's exactly the kind of stock you want to be in a recession. Are people going to stop taking their medications? Of course not. Is the government about to stop paying Pfizer? Of course not. And again, this is a weekly chart. What you could see right now, which is typical charting behavior, is for Pfizer to go down again in a retest for this sloping line of resistance, now support, see how it holds, and then bounce higher again. Next, what about the ticker PM, Philip Morris? You look at Philip Morris, for example, PM. A weekly chart. Again, still weak, still making lower lows and lower highs, but is it working its way to reclimb the trend line again? We see positive impressions in the histogram of the MACD. These are the kind of names that tend to outperform in a recession. And here's the update. Look at this. PM scored gains of about 8.5% since then, and it made it above the trend line that was resistance, now support once again. And in typical charting behavior, this is a weekly chart, we see after a massive breakout of a major trend line, we see a retest, so PM could go down on a retest and then bounce higher again and challenge the previous high. Once again, tobacco stocks, the kind of stocks you want to be in if the economy and the stock market is heading into a recession. Next, we have SPG. Let's hear what I said and come back. How about Simon Properties? The ticker SPG, a weekly chart, a massive rally as of late, but it is facing resistance at around 119. Is it going to stall? Is this it for SPG and down we go? Well, here's what I know. I'm not really looking to bet on SPG one way or the other, calls or puts. I'm using SPG as a leading indicator. Leading indicator to what? To the 10-year yield. When we switch the aligned chart, you can see SPG, Simon Properties in red, and the TLT for bond prices in orange. Since quantitative tightening started, you can see the correlation. When the TLT moves down, Simon Property, real estate, also goes down. On the other hand, when we see a rebound in the TLT, we see a massive rebound in Simon Properties. But usually, the reaction of Simon Properties happens before the move in the TLT. meaning before the move in the 10-year yield. So if I see SPG moving down significantly from this point on, my assumption would be the 10-year is going to pop higher again. But if I see SPG adding to the gains, that would be a confirmation to me that the 10-year is going down. We're talking about yields here. Why is that of benefit? To know whether yields are going to go higher or down? Well, we can trade based upon that information. And again, here's the update. This was not a tradable position at all. I was just using SPG as a pulse to where the 10-year yield is going. And so far, SPG, while forming a bull flag pattern, did not pop higher. And what that tells me right now, number one, don't get too excited as a bear by the pop that we got today in the 10-year yield. Because if SPG forms this bull flag and it plays out, the likelihood is the 10-year is going to go down again. However, keeping in mind, the 10-year has been going down significantly, while SPG has been consolidating, not moving higher. This is called relative weakness. In other words, we could see this bull flag formation not playing out, and as the 10-year pops higher again, we could see SPG moving down and failing to crack above this resistance of 119. So keep that in mind. Next, we have Verizon, the ticker VZ. Let's hear what I said and come back. Another one, Verizon VZ, a weekly chart. Again, bruised, beaten, nobody wants this name. But it's exactly the kind of name that tend to outperform when we have a recession. And since then, we got a pop of about 2%, but since then it turned down and it lost about 4% since we talked about it. But here's the thing. What I'm looking at Verizon right now is it going to make a higher low? And if it does, higher it goes from that point on. We could also wait for a double bottom, and then it goes higher again. But obviously, if the higher low or the double bottom doesn't work out and we see the chart piercing below the previous low, not a good timing. But here's the thing. Verizon is the kind of stock that outperforms in a recession. This is what you really have to pay attention to. In purple, this is Verizon. In orange, the chart of the 10-year yield. And as you can see, when the 10-year moves higher, Verizon goes down. Why? Because Verizon is a dividend giant, and now it pays about 6% or so. But if the 10-year is paying 4% and Verizon was paying, 5% at the time? It becomes a competition here for yield. And I'd rather go with the risk-free capturing 4%, or even better, buying the 2-year where it can capture even more than 4% in yield, risk-free, rather than taking the risk in Verizon. But now that the 10-year is going down, we see Verizon moving higher again. And at some point, if yields go down and the trend becomes, hey, yields already topped, at least in the 10-year, and the trend becomes that the 10-year is going to be at 3.5 soon, then 3, then 2.5. If that is the trend, if you believe in that, then Verizon is a buy. Because now you got a declining yield on the 10-year, the 2-year, but you got a massive, generous 6% plus dividend from Verizon. This is a deal you cannot pass on, especially now that the stock is down big. But you gotta be sure that the 10-year is down. And the trend from this point on for the 10-year yield is down, which by the way means that a recession is about to hit the economy. If that is the case, you put 2 and 2 together, it is time to buy Verizon because it's not only a recessionary kind of stock, but it also offers a really decent dividend that now overshadows the yield from the 10-year, the 2-year, or any kind of fixed income yield. Anyhow, folks, these are just updates for charts that we covered before. Hope you found this video informative, and if you did, press the like button, subscribe, leave a comment, you know the deal. And this is just an appetizer before the main course. The main video is coming out this evening, so stay tuned.